Good morning. This is Barry Knapp with Ironsides Macroeconomics. It's 7:20 a.m. Mountain Time on Monday, February 5th. This is the free version of our weekly summary that goes through our weekly note, which you also received an abbreviated version of as a free subscriber. The note this week was titled Confidence Men. It was a fascinating week, and this report was chock full of both policy-related issues. We went through the Treasury's quarterly refunding announcement, the amount of financing they expect to need in both the first and second quarter, the composition of that, the debt that they're going to sell, which was really important. The market looked past it, but less so this week as we auction 3s, 10s, and 30s in larger size than prior months. And of course, the Fed announcement as well as the banking situation. So on the quarterly refunding announcement, the Treasury Secretary Yellen did seem to listen to some of the issues that we and others have raised about them draining liquidity out of the system by issuing more bills than the Treasury Borrowing Advisory Committee suggested that they do. They're now expecting over the next 2 quarters to shrink the amount of bills outstanding by $317 billion and increase the amount of coupons outstanding by $519 billion. All things being equal, that should be a yield curve steepener that should push longer term rates up. We are getting that this morning with longer term rates up from 10s and 30s, about 10 basis points. We got some of that on Friday as well. But that for us is a really big deal. The Fed clearly is not going to be hiking in March. The data is not supportive of that. And because of the actions of the Treasury, they may be able to continue QT longer than we thought a week or so ago before this announcement, in which case that could put pressure on the long end as well. Mortgages will continue to pay down and run off. So all those things add up to higher longer term rates. We're getting it this morning, and we think we'll get more of that going forward. So moving on to the banking situation for us, that was a manifestation of all the concerns we've been expressing. Problems in multifamily real estate, problems with the bank capital requirements that are being put forth by the administration and the administration's appointees into the bank regulatory apparatus, bad ideas. And the Fed views this as somewhat isolated. They can resolve it with, with regulatory policy. But ultimately, we think this was created by monetary policy and is an issue for them. Moving on to the payroll report, curiously, they announced the annual population control number. A year ago, they found 1 million extra workers. This year, they found that we had 625,000 fewer workers. That's kind of a shocking result, but it does call into question the Fed's broader narrative about this idea that the supply side of the labor market has also adjusted like supply chains did, and that will cause the labor market to come into balance. That data is all very much in flux. We don't really believe the headline numbers. This is the third year in a row we've had a big jump in January. We think it's related to seasonal adjustment factors that were corrupted by the pandemic. But, again, to get deeply into those details, you should be a full subscriber. So moving on from there, we delved into the earnings story. It is being driven by big cap tech. Expectations are pretty outsized for those sectors. The stocks that are trading off on the day that they announce earnings are consumer discretionary tech and real estate. Bottom line here, when we look through revisions and the shape of the earnings recovery, is we're not really getting a V-shaped recovery out of the earnings recession we had in the fourth quarter of 22 and first half of 23. We are getting a global trade and manufacturing recovery going on, though. Asian exports have started to pick up. PMIs in Asia have started to pick up. That's all very encouraging. We had lots of encouraging data last week on capital investment here in the U.S. and potentially some favorable policy results as well. And when we put all this together, we think we're very much still in the same spot we've been in through the course of this year, where It's too early for the healthy broadening out. Until the Fed starts an aggressive rate cutting cycle, we would not be in small caps or small banks. We'd still stick with market weights in tech and tech related sectors, and the industrial sector overweights we would have, or the cyclical sector overweights we would have, would be industrials, materials, and energy. That's it for me this week. Consider becoming a full subscriber. Barry Knapp from Ironsides. Thanks. Have a good week, everyone.